Welcome to the team. Seriously, we are so thrilled to have you on board. Today, we're jumping right into a practical, on-the-job explainer masterclass. We're going to tackle what is literally one of the most critical standards you're going to use every single day, AASB 15, Revenue from Contracts with Customers. Think of this explainer as your essential everyday toolkit. We'll be looking at real-world scenarios you're going to see in client files, starting from standard sales all the way up to complex, long-term construction projects. My main goal today is to help you build a rock-solid foundation so you can review these files with absolute confidence. Here's our roadmap for today. We'll start with income, revenues, and gains. Then we'll walk through the 5-step revenue model. After that, we'll tackle variable consideration and returns, dive into multi-year financing and options, navigate long-term construction, and finally, wrap things up with a handy revenue recognition checklist. All right, let's kick things off with Section 1, Income, Revenues, and Gains. Let's start by anchoring ourselves on exactly what it is we're actually measuring here. According to the conceptual framework, income is an increase in assets or a decrease in liabilities that results in an increase in equity. But within that broad umbrella of income, we have a really crucial split: revenues versus gains. Revenues happen during the ordinary, everyday activities of a business. Think of a local bakery selling sourdough bread, a consultant charging their hourly fees, or a bank earning interest. Those are everyday revenues. Gains, on the other hand, well, those represent other increases in economic benefits that might not be part of that normal routine. For example, if that same bakery decides to sell its delivery van for more than its carrying amount, that's a gain, not revenue. It's an intermittent event. AASB 15 specifically focuses on revenues arising from contracts with customers. Moving right along to Section 2, the 5-step revenue model. Okay, this right here is your bread and butter. The definitive 5-step model beautifully standardizes every single transaction. It's kind of like a set of gates. Step 1, you identify the contract with the customer, basically asking, is there a legally enforceable agreement here? Step 2, identify the separate performance obligations. What exactly did we promise to transfer to them? Step 3, determine the transaction price. How much cash are we actually getting paid? Step 4, you allocate that price to the various obligations you found back in Step 2. And finally, Step 5, recognize revenue when or as each performance obligation is satisfied. You literally cannot record a single dollar of revenue until you've successfully passed through these 5 gates. Honestly, Step 5 is where you're going to spend most of your time because it all hinges on one massive concept: control. An asset is transferred when the customer obtains control of it. But how do you actually prove that in a client file? Well, here are your practical desktop indicators. Just ask yourself, does your client have a present right to payment? Has the legal title formally transferred to the customer? Do they have physical possession? Have the significant risks and rewards of ownership passed to them? And finally, has the customer formally accepted the asset? If you can check these off, you can safely confirm control has transferred. And boom, revenue can be recognized. Let's dive into Section 3, Variable Consideration and Returns. So what happens when the amount of money we expect to receive isn't a fixed, guaranteed number? When the transaction price is variable, AASB 15 requires us to estimate it using one of two methods, depending on which better predicts the final outcome. The first is the expected value method. This is where you sum up probability-weighted amounts. For example, say a client is selling 100 bikes at $500 each, but customers have a 30-day right of return. You might use historical data to assign probabilities. Say a 15% chance 0 bikes are returned, a 20% chance 1 is returned, and so on. You calculate the revenue for every scenario and weight it by its probability. The second method is the most likely amount method. If the contract really only has a couple of possible outcomes, like achieving a specific performance bonus or not, you just pick the single most likely outcome. Simple as that. Let's actually see this in action with a standard right of return. Picture your client selling 100 products for $100 a pop in cash. Based on the most likely amount method, they expect exactly 3 products to be returned. Do we recognize $10,000 in revenue? No way, absolutely not. We only recognize the consideration we actually expect to be entitled to. So we record $9,700 in revenue for the 97 products we expect to stay sold. And that remaining $300, that gets recorded as a refund liability. We also record a corresponding asset for the right to recover those 3 products from the customer, assuming the recovery cost is immaterial, of course. Next up, Section 4, Multi-Year Financing and Options. Sometimes your client sells a product but lets the customer pay it off over several years. That means we've got a significant financing component on our hands. Take Cassie Ltd, for example. They sold a computer costing $9,000, not for quick cash price, but for a promissory note requiring 3 annual payments of $5,000. That is $15,000 total, but the actual current sales price equivalent is just $12,009. That difference? That's interest revenue. Using the effective interest method, with an implicit rate of 12%, we have to calculate the interest each year based on the outstanding liability. In year 1, 12% of $12,009 gives us $1,441 in interest revenue. The rest of that $5,000 cash payment simply reduces the principal. You must remember to separate this interest revenue from the regular sales revenue in the accounts. Another tricky condition you're absolutely going to run into involves call and put options attached to a sale. A call option gives the seller the right to buy the asset back. A put option gives the buyer the right to sell it back. So the crucial point you need to remember is this. If your client sells an asset but holds a call option allowing them to buy it back, and the market price is likely to be greater than the exercise price, well, they haven't really given up control at all. In substance, it might just be a financing arrangement and no sale should be recorded. The exact same logic applies to put options. If the buyer has a put option and the exercise price is likely to be above market price, basically guaranteeing them a minimum return, a sale should not be recognized.
All right, getting into the heavy-hitting stuff. Section 5, Navigating Long-Term Construction.
Now we tackle what is arguably the most complex topic in revenue recognition: performance obligations satisfied over time. Think about it. If an entity is building an asset on a customer's land, the customer actually controls that asset as it's being created from the ground up. Because of that, we don't just wait 3 years to recognize all the revenue at the very end, we recognize it progressively. Imagine a company, XYZ, signs a $20 million contract to build a warehouse over 3 years. Total estimated costs are $16 million. In 2023, they incur $5 million in costs. In 2024, it's $8 million, and in 2025, the final $3 million. Notice how the cash billings to the customer don't perfectly line up with the costs? Yeah, we cannot just recognize revenue based on whatever cash we happen to bill. We need a highly systematic way to measure our progress. AASB 15 requires a method that best depicts the transfer of goods or services. You've basically got 2 choices: output measures or input measures. Output measures involve surveying the actual physical result. You literally go out to the site, look at the physical warehouse walls that have been built, and appraise the results achieved. Input measures, on the flip side, look at the effort required to get there. It's measuring the sweat, the labor, and the raw materials used, specifically the costs incurred to date compared to the total expected costs.
So the most common input measure you'll see is the cost method, which calculates the percentage of completion. The math here is pretty straightforward, but it's absolutely crucial you get it right. You take the cost incurred to the end of the current period and divide it by the most recent estimate of total costs. Returning to our XYZ warehouse in 2023, they incurred $5 million out of a total estimated $16 million. 5 divided by 16 gives us our percentage of completion for year 1. We then apply that percentage to the total $20 million contract price to find the revenue we can recognize this year, which works out to $6.25 million. One major trap to watch out for, though. Only include costs that actually reflect work performed. Do not include wasted materials in that calculation. Let's wrap things up with Section 6, the Revenue Recognition Checklist. We have covered a ton of ground today, so let's condense this whole shebang into a practical toolkit. I highly recommend keeping this ultimate summary checklist pinned right to your monitor. Whenever you review a revenue file, verify every single step. 1, do we actually have an enforceable contract? 2, are we unbundling all the distinct performance obligations, like, say, separating the sale of a van from an included roadside service plan? 3, have we properly estimated any variable consideration or stripped out any multi-year financing interest? 4, did we allocate that transaction price accurately based on standalone selling prices? And 5, has the customer truly gained control, either at a single point in time or progressively over time based on our input or output measures? By systematically applying this 5-step model, you literally take all the guesswork out of revenue recognition and ensure strict compliance with AASB 15. The numbers on these spreadsheets represent real economic activity, and it is our job to tell that story accurately. So as you open up your very first client file today, I want you to look at their revenue streams and ask yourself, how am I going to apply the 5-step model to test this? Which indicators of control are actually present? You've got the tools, you know the rules, and now it's time to put it all into practice. Thanks for joining me on this explainer, and good luck out there.
All right, welcome to the boardroom, everyone. I am absolutely thrilled to have you. Think of me as your senior financial advisor, and today we're going way beyond the basic compliance of accounting. In this explainer, we're going to really unpack the strategic realities of financial reporting. We hear the term bottom line thrown around constantly in business. But as leaders and decision makers, you need to know that what often passes for the bottom line is honestly just the tip of the iceberg. So we're going to dive into the true financial narrative of a company. Let's get started.
So here's our roadmap for today's explainer. First, we'll cover the true bottom line, then nature versus function reporting, tracking changes in equity, the power of estimates, the alternative measures trap, and finally, we'll wrap up with the ultimate blind spot.
Okay, let's jump right into Section 1, the true bottom line. This is all about peeling back the layers of income. When most people glance at an income statement, their eyes just immediately dart straight to that profit or loss figure, right? They think, awesome, we made money, or uh-oh, we took a hit. But as executives, you have to peel back that surface layer. To get the full picture, we really have to look at total comprehensive income. This is actually the aggregate of two very distinct parts. On one side, sure, we have standard profit or loss, the everyday expenses and incomes we're all super familiar with. But on the other side, we have other comprehensive income, or OCI. Now, these are specific items of income and expense that accounting standards literally forbid you from putting into your standard profit or loss. If you're only looking at profit or loss, you are missing a massive chunk of your actual financial reality.
Because look, income isn't just one monolithic thing. It's split into revenues and gains. Revenues are what you generate from your ordinary day-to-day activities. Like if you run a car dealership, selling cars generates revenue. Makes sense, right? But what if that dealership sells the actual plot of land the showroom sits on because property values just absolutely skyrocketed? Well, that is a gain. It absolutely increases your equity, but it is not part of your ordinary operations. Knowing the difference between these two is absolutely crucial because it tells you whether a company is actually good at its core business or just, getting lucky with a one-off windfall.
So what actually goes into this hidden layer of other comprehensive income? Well, under the AASB 101 standard, it includes things like changes in your revaluation surplus. Say your property portfolio suddenly jumps in value. It also includes remeasurements of defined benefit plans, gains or losses from translating the financials of your overseas operations, fair value changes on equity instruments, the effective portion of cash flow hedges, and even changes in credit risk for designated liabilities. These are massive financial swings. Ignoring them is literally like driving a race car with one eye closed. It just leaves this huge blind spot in how you evaluate performance.
Moving right along to Section 2, nature versus function reporting. These are your operational choices in presentation.
As executives, you aren't just passively receiving these financial statements. Your team actually has operational choices in how your expenses are presented to the public. Preparing these statements follows a pretty structured breakdown. First off, management has to choose the format, nature or function. Second, you aggregate your expenses based on that choice. Third, you add that other comprehensive income we just talked about to your profit, which gives you your total comprehensive income. And finally, you absolutely must disclose the tax impacts of those OCI components. So it's a very structured flow from raw data straight to the final comprehensive picture.
Now, looking at this, you basically have two distinct choices here. The nature approach groups expenses by what they literally are. Things like depreciation, raw materials, transport costs. It's super simple and highly objective. The function approach, on the other hand, groups expenses by their role: cost of sales, distribution, administration. Now, the function approach might actually be a lot more relevant to investors who are trying to understand your margins, but, and this is a really big but, it requires management to make arbitrary allocations. Deciding exactly how much of the corporate electricity bill goes to distribution versus administration involves a ton of judgment, and that introduces subjectivity right into the very heart of your expenses.
All right, Section 3, tracking changes in equity. Let's connect the dots between periods.
Think of it this way. You've got your starting position and you've got your ending position. How on earth did you get from A to B? Well, the statement of changes in equity is your crucial connecting tool. It reconciles those opening and closing balances. It basically acts as a bridge. It factors in how your retained earnings were boosted by the year's profit, but then may be drained by the dividends you paid out. It shows how the revaluation surplus moved because of those specific OCI items we discussed earlier, and how share capital changed if, say, you issued new shares. It's really the complete, overarching story of the owner's wealth in the company over the entire reporting period.
Next up is Section 4, the power of estimates and the subjective reality of accounting. I kind of want to shift gears just a bit here because, honestly, this is where the heavy weight of executive responsibility really lies. Accounting is not just rigidly adding up concrete numbers. It is a highly subjective reality based heavily on your estimates. Consider this real-world example from BHP's 2019 annual report. Management constantly has to make estimates about future events, like, specifically, whether an economically viable extraction operation can be established. If their assumptions change down the line and they decide, well, recovery is unlikely, massive amounts of capitalized expenditure are suddenly charged directly to the income statement. So a simple change in an executive's estimate about the future can literally wipe millions off the profit line today.
And because these estimates are so incredibly powerful, auditors are, quite frankly, obsessed with materiality. The AASB 101 defines materiality beautifully right here. Basically, information is material if leaving it out or hiding it would change an investor's decision. That is the ultimate test. It's not just about the raw size of the number, it's entirely about the nature of the information itself.
So, when non-recurring events pop up and they pass that materiality test, they require strict separate disclosure. We are talking about massive write-downs of inventory, major company restructurings, selling off plants, discontinuing operations, or, giant litigation settlements. You absolutely cannot bury these in your ordinary expenses. Auditors evaluate these rigorously to ensure the primary users, meaning your investors, aren't being misled about what is actually happening under the hood of the business.
Which brings us to Section 5, the alternative measures trap. Let's talk about the temptation of non-complying metrics. As an advisor, I've got to say, this is where I see the absolute most risk in the boardroom, the temptation to step outside standard reporting rules. So I'll pose this question directly to all of you. Why do managers invent metrics like underlying profit or cash earnings? Well, when the strict, rigid rules of accounting don't perfectly tell the growth story that the board wants to see, there's a really strong temptation to just create a bespoke, non-complying performance measure.
Now, sometimes these motivations are entirely genuine. Managers might truly believe their custom metric provides a far superior indicator of true performance by stripping out all that one-off noise, making it super useful for internal tracking. However, let's be totally honest here, it can also be opportunistic. It can be a highly creative way to inflate numbers and maybe even trigger executive bonuses by exploiting the simple fact that management knows a whole lot more than the investors do. But let me warn you right now, regulators like ACIC in Australia watch this stuff like hawks. Misleading alternative disclosures will absolutely result in rapid regulatory action, no question.
And that brings us to our final section, Section 6, the ultimate blind spot. What traditional financials simply ignore.
For all the rigor we've talked about today, the OCI, the equity bridging, the materiality, traditional financials have one massive, almost systemic limitation. And it all boils down to how the conceptual framework actually defines an asset. An asset is an economic resource controlled by the entity. That word controlled right there, that is the absolute linchpin.
Because here's the really hard truth of our current accounting model. Since a company does not legally control the air, the oceans, or the broader waterways, traditional financial profit completely ignores environmental degradation. Pumping pollution into the air absolutely diminishes a resource, sure. But since it's not a controlled asset, it's just not recorded as an expense anywhere in your income statement. Focusing solely on financial profit fundamentally misaligns with broader stakeholder expectations today simply because it legally ignores massive social and environmental costs.
So I'm going to leave you with this final thought for your next board meeting. We have spent this entire explainer defining the true financial bottom line. But if that bottom line completely ignores the very environment and society we actually operate in, are we really measuring our total performance? It's a huge question, and one every modern executive is going to have to answer. Thank you so much for joining me for this explainer, and I will see you next time.